Welcome to Rivian DD. This is my Rivian Q3 earnings preview. We'll start by taking a look at some of the Wall Street consensus estimates and then cover some of the key developments since last quarter, which I expect management will discuss in more detail on the earnings call. So kicking it off with the estimates for revenue. Expectation is for about 1.51 billion of revenue in Q3. This compares to 1.3 billion in the prior quarter. In Q3, Rivian delivered 13,201 vehicles. So if we take that and multiply by an average selling price of about, let's say 88,000, I think this will be slightly higher than the 87,000 we saw in Q2 due to the release of the quad motor in Q3. So that gives us about 1.16 billion in automotive revenue. And then on the software and services side, last quarter we saw about 376 million in software and services revenue, roughly equally split between revenue from the joint venture with Volkswagen and core software and services revenue, which includes things like charging on the Rivian Adventure Network, remarketing, connectivity, and other software subscriptions, as well as, of course, service. But this part of the business is growing quite quickly. Last quarter, we saw quarter-over-quarter growth of just under 10% for the joint venture. And then on the core revenue, we saw a 28% growth quarter over quarter, which is pretty wild. This has doubled in the last 9 months and continues to grow as the size of the car park grows. And Rivian hasn't even started charging for the Autonomy platform. So yeah, I think this is going to continue growing every quarter. But let's just assume a modest 10% growth in Q3. That gets us to about 414 million of software and services revenue, or a total of 1.58 billion compared to the consensus estimate of 1.51. So I think they'll come in at or above consensus here on the top line. In terms of gross profit, this is going to be tricky to estimate given some of the volatility we saw in Q2, which was largely driven by the low production numbers. Rivian produced just under 6,000 vehicles in Q2 due to some supply chain issues, in particular rare earth export controls. And so they had really poor fixed cost absorption. You can see that here in the depreciation per vehicle, but also probably came in other parts of the cost of revenue. We also saw an increase in write-downs for LC and RV, which had been on a downtrend for many quarters, and suddenly an increase in the number of write-downs here. We didn't get an explanation from management as to what's driving this. If I had to guess, it could be related to the transition from model year 2025 to 2026, and perhaps management's expecting that the 25 inventory will need to be discounted in order to move those units, but really just speculation here. In addition, we also saw quite a big increase in warranty accruals, which had been on a pretty steady downtrend since the release of the Gen 2 vehicle last year. And again, we didn't get an explanation as to what's driving this spike. But if we just sort of take a bottoms-up approach to calculating this, we can assume, let's say, 11,000 per vehicle in depreciation, SPC back to Q1 levels. Perhaps this reverts to the trend we saw before, and we see a decrease in write-downs, maybe some modest improvements here. And let's also assume that the bill of materials continues getting cheaper, and they can reduce this by about 2,000 a vehicle. So that would give us a gross loss of 16,000 per vehicle, or 215 million in overall automotive gross loss. If we assume some modest improvement in software and services, that gets us to an overall gross loss of 75 million. Of course, there's a lot of ways this can change, but it's hard to know without knowing some of the root causes of what we saw in Q2. Another approach to calculating gross loss for the quarter is we can simply look at so management in the Q2 shareholder letter, they outlined what the impact of the low production was on kind of the fixed cost absorption. So here they say, as a result of the lower volumes, we essentially took a hit of 137 million compared to more normalized production. So if we just assume, let's say everything in Q3 is the same as Q2, and we adjust out this 137 million, that gets us to a gross loss of 198 million on the automotive side, which is pretty similar to the estimate we just calculated. And that would give us an overall gross loss of 58 million. Now, if we look over at the estimates for earnings per share, let's see, we've got a consensus estimate of 71 cents per share loss compared to 80 cents per share in Q2. This is going to be, primarily driven by the gross loss numbers we just calculated, as well as the change in operating expenses. So in Q2, we saw quite a big step up in OpEx compared to Q1. And, this is going to keep growing as the business prepares for R2. They're opening new service centers, adding new chargers, and staffing up in order to support the significant ramp up coming in 2026. So I expect to see this continue to grow. If we take a look at the EPS numbers for Q2, there was an adjusted net loss of 920 million, and we can take that 920 and adjust for the 137 million that management laid out for the underproduction, and then let's say we assume another 50 million or so in OpEx increase. That gets us to a adjusted net loss per share of 69 cents, which is kind of just under the consensus numbers. So yeah, pretty much in line with what the market's expecting, perhaps a slight beat there on the bottom line. All right, let's talk about some of the major developments that we've seen since the last quarter. The first one will be R2. So Rivian's shared a number of updates on the design validation builds that they've produced out in California on the pilot line. They have said there's hundreds of them out on the road testing. We even saw a pretty cool video of them driving around, probably somewhere in California. And RJ also shared a video of the body shop in the new factory in Normal. You can see a lot of the robotics are already set up and installed and starting to move through some of their motions. So things are really coming together for R2 production next year. We also saw an interesting update that Chris Hilbert shared on X, referencing a LinkedIn post that talked about virtual commissioning of the body shop that was happening from October 22nd to November 19th. So that's a really interesting data point. And if you kind of think through some of the next steps for the development process, I think this puts start of production for R2 somewhere around March or April, which is consistent with their guidance for the first half of 2026. I think the $1 million question is whether management will kind of go ahead and commit to a start of production date on this earnings call. I think it's more likely they wait until the Q4 earnings call, which will be in late February, which is pretty close to that start of production. But yeah, it really just depends on how confident they are in the current stage of the process. They may even talk about when they'll release the configurator, which I know a lot of the reservation holders are eagerly awaiting. So yeah, I think this will be certainly a topic on the call, but unclear how much detail we'll get around that start of production for next year. The next major topic is on autonomy. During the quarter, Rivian released a couple important software updates to improve the autonomy system. The first was in August in 2025.26. There was a number of different upgrades to improve performance, and it's not mentioned here in the release notes, but someone on Reddit had made the observation that this was the first time that Rivian has fully transitioned over to its perception stack. Previously, it was still using the Mobileye camera and software for aspects of its system. But following this release, they're now fully reliant on their perception stack. So that's an important milestone in kind of their larger roadmap. There was another software release in September, which also had a number of improvements to enhanced highway assist. Specifically, they introduced a co-steer feature and improved lane centering, as well as increasing the availability of highway assist by 50%. So the number of the roads that you can actually use it on increased pretty significantly. And these are all really positive developments. They've got their Autonomy Day coming up on December 11th. So I expect, RJ and team will be discussing that on the call, but probably not give away too much in terms of upcoming features or development. They'll want to save some of that for the event in December. The next major topic is on tariffs. So a few weeks ago, there were some pretty major developments in terms of the tariff relief that the administration is providing to American automakers. Previously, there was a tariff offset of 3.75% of MSRP for vehicles assembled in the U.S. And this went through April 2026 and then stepped down to about 2.5% through April 2027 and then expired. And this new development essentially maintains the tariff relief offset at 3.75% and extends it out to 2030, which is a pretty major, essentially makes tariffs a non-issue for vehicles assembled in the U.S. And certainly benefits Rivian as they scale production from 40-ish thousand units per year to over 600,000 units per year in 2030. We saw a couple weeks ago when Ford and GM released earnings that Wall Street was sort of surprised by how much this measure improved their forward outlooks, and so I expect we'll hear some discussion of that on the earnings call. I just did some kind of back of the napkin math to estimate the impact of this to Rivian specifically. Here you can see the original proposal, which expired in 2027, and the new one, which has been extended at the higher rate. And of course, I made some assumptions here around R2 and R1 EDV production and the associated revenue with those units. But you can see that there's a pretty substantial difference in the two versions of the tariff offset plan, and this is worth close to $3 billion to Rivian and about $2 billion in present value. Of course, I'm assuming that they can capture the full 3.75% of MSRP, but I think that's reasonable given management's comments in the Q2 earnings call, where they indicated that the tariff headwind for R2 specifically was on the order of a couple $1,000s per vehicle. So I think this is quite a positive development for the company as they scale over the next 5 years. And I'm a little bit surprised that the market didn't really react when this was first announced. So yeah, I think it'll be interesting to hear what management, what additional color they can provide. I wouldn't be surprised if they sort of double down on their 2027 target of hitting positive adjusted EBITDA. They mentioned that tariffs and other policy changes really were a major headwind to hitting this in the prior earnings call, but now that this has been extended out, I wouldn't be surprised to hear them kind of reiterate that goal in a more confident way. The next major development since the last call was just last week, I believe. There were some comments from Claire McDonough, the CFO, indicating that they were not expecting to tap the $6.6 billion Department of Energy loan until 2028, which is pretty surprising, given their sort of liquidity position. They're starting construction on the facility next year and are planning to spend close to $2 billion in capex for the year. So I'm a little bit surprised to see that they're not planning to actually start drawing from the loan until 2028. Would love to get some kind of more clarity on this. There are some conditions precedent on drawing the loan, but I expected them to sort of hit those by late next year once R2 production is ramped up and they're demonstrating that it has a solid margin profile, and that there's sufficient demand to build the Georgia facility. But yeah, I would love to get some more clarity on these comments. I took a stab at kind of estimating what their liquidity looks like through the end of next year, and it seems to me that between the capex that they've guided for this year, as well as the planned capex for building the Georgia facility, combined with their kind of quarterly cash burn just to run the business, it looks like they're going to be dipping close to $2 billion in cash by the end of 2026, which is too low for what the market is kind of expecting them to have in terms of liquidity. Suppliers would probably want to see a healthy cash position as well. So I'm expecting that they're going to have to raise capital, maybe $1 to $2 billion next year if they're not going to be drawing on the Department of Energy loan. But again, it's just going to be good to get some additional clarity on how they're thinking about this. There's a couple other topics that I'd be interested in hearing more about on the call. In particular, the recent deal with China on rare earth supply, which of course constrained Rivian's production in Q2. So hopefully they're sort of optimistic about the supply chain issues as we look forward to R2 in 2026. And then they have reduced their guidance for 2025 deliveries a few times throughout the year. And most recently on the production and deliveries report, they narrowed the range for full year deliveries, adjusting down the total deliveries by about 500 vehicles. So now that we're about a month into Q4, I'd be interested in getting an update on how things are shaping up so far. So that's it for today's Q3 earnings preview. I hope you enjoyed it. If you're interested in more Rivian specific deep dives, hit that subscribe button. And if you have any questions, feel free to drop them in comments below.